Net operating income is the biggest lie in real estate investing. It is the valuation metric, not the liquidity metric. Many properties showing positive net operating income are actually cash flow negative. True profit requires two mandatory deductions often ignored. You must account for the full debt service payment. You also need to reserve funds for future capital expenditures. A property with positive net operating income can still demand monthly capital injections. Cash flow determines if you are building wealth or subsidizing a liability. Lenders and appraisers rely solely on net operating income for valuation purposes. They use the debt service coverage ratio based on this figure. Investors must focus on the actual cash remaining in their pocket. This difference determines the investment's long-term viability and sustainability. Net operating income ignores the cost of financing the asset. It also ignores the inevitable cost of replacing major systems. We calculate true cash flow to avoid unexpected capital calls. Gross scheduled income is the maximum potential rent collection. This assumes the property is 100% occupied. It also assumes all tenants pay their rent on time. Vacancy and credit loss must be subtracted from this maximum figure. This deduction reflects the reality of tenant turnover and non-payment risk. Underwriting standards typically apply a vacancy and credit loss rate. This rate usually ranges from 5% to 10%. The specific rate depends on the local market stability and property class. Effective gross income is the result of this subtraction. Effective gross income equals gross scheduled income minus vacancy and credit loss. This figure represents the realistic revenue stream available. This revenue is calculated before any operating expenses are deducted. Accurate estimation of vacancy loss prevents overstating potential returns. Always use conservative vacancy rates for new acquisitions. Market data provides the best basis for setting this crucial percentage. Effective gross income is the starting point for calculating profitability. Operating expenses are the costs required to maintain the property's functionality. These expenses are necessary to generate the rental income. Operating expenses exclude debt service and major capital improvements. Property taxes are a mandatory component of operating expenses. These are ad valorem taxes based on the property's assessed value. Property insurance covers hazard risks and liability exposure. Professional management fees are typically 8% to 12% of effective gross income. Other operating expenses include owner-paid utilities and routine maintenance costs. Routine repairs keep the property functional but do not extend its useful life. Operating expenses must be accurately estimated using comparable property data. Historical data from similar assets provides the most reliable figures. Underestimating operating expenses is a common investor error. Accurate expense tracking ensures the net operating income calculation is reliable. These expenses are deducted monthly from the effective gross income. Net operating income is calculated by subtracting total operating expenses from effective gross income. This figure represents the property's income stream before financing costs. Net operating income is the standard metric used by commercial lenders. Lenders use net operating income to calculate the debt service coverage ratio. The debt service coverage ratio is net operating income divided by the annual debt service. Most commercial lenders require a ratio between 1.20 and 1.25. This ratio ensures the property generates sufficient income to cover loan payments. It provides a necessary safety margin against unexpected costs. Net operating income is also the basis for property valuation. Appraisers use the capitalization rate or cap rate for this purpose. The cap rate is net operating income divided by the property value. A higher net operating income directly increases the asset's market value. This metric ignores the investor's specific financing structure. Capital expenditures cover non-recurring major replacements or improvements. Examples include replacing the roof, the HVAC system, or major appliances. Capital expenditures are not classified as routine operating expenses. These costs must be reserved monthly to prevent future cash flow shocks. Failure to reserve capital expenditures artificially inflates apparent monthly cash flow. This practice leads to unexpected large expenses later. A common reserve rate for smaller multifamily properties is $200 to $300 per unit annually. For larger assets, 5 to 10% of effective gross income is often reserved. These reserves ensure the long-term physical sustainability of the investment. They maintain the property's value and tenant desirability. Always treat capital expenditure reserves as a mandatory monthly expense. This discipline separates successful investors from those facing sudden financial distress. Reserves smooth out the financial impact of major repairs. Debt service is the total monthly payment covering the mortgage loan. This payment includes both principal repayment and interest charges. Debt service is typically the largest single deduction after operating expenses. Only the interest portion of the debt service payment is tax deductible. The principal repayment increases the investor's equity in the asset. However, principal repayment reduces immediate spendable cash flow. The debt service amount is fixed based on the loan's amortization schedule. It is also determined by the interest rate and the loan term. Accurate debt service calculation is essential for determining true profitability. Ignoring the principal portion misrepresents the liquidity position. Debt service is the cost of leveraging the investment for higher returns. This payment structure is fixed for the duration of the loan term. The principal portion builds wealth through forced savings.
Pre-tax cash flow is the definitive measure of liquidity and true profit. This metric shows the actual spendable income generated by the property. Pre-tax cash flow is calculated using a simple formula. Take net operating income, subtract the full debt service payment. Then subtract the mandatory capital expenditure reserves. A positive pre-tax cash flow means the property is self-sustaining. It generates spendable income after all obligations are met. A negative pre-tax cash flow requires the investor to subsidize the investment. This subsidy comes from the investor's external funds monthly. Pre-tax cash flow determines the immediate financial return on the invested capital. This figure is the most important for evaluating short-term investment performance. It reflects the true monthly cash position of the asset. Always calculate pre-tax cash flow before making any investment decision. This metric is the foundation for calculating the cash-on-cash return. Depreciation is a non-cash expense providing a significant tax shield. Investors deduct the cost of the building structure over time. Land value is explicitly excluded from the depreciable basis. Residential property is depreciated over 27.5 years. Commercial property uses a 39-year straight-line depreciation schedule. This deduction reduces the property's taxable income significantly. It often results in a paper loss reported to the Internal Revenue Service. This paper loss occurs even when the property generates positive pre-tax cash flow. This tax advantage allows investors to receive tax-free cash flow. The cash flow remains tax-free until the depreciation basis is fully exhausted. Depreciation effectively lowers the investor's overall tax liability. Consult a tax professional to maximize this powerful real estate benefit. This tax shield is a key driver of long-term wealth accumulation. Cash-on-cash return is the primary key performance indicator for leveraged real estate. It measures the annual pre-tax cash flow against the total cash invested. Total cash invested includes the down payment and all closing costs. The formula is annual pre-tax cash flow divided by total cash invested. Multiply the result by 100 to express it as a percentage. Cash-on-cash return provides a direct comparison of equity performance. It allows investors to compare this return against alternative investment opportunities. A typical target cash-on-cash return ranges from 8% to 12%. This range signifies an attractive cash-flowing deal. This metric is superior to the capitalization rate for leveraged deals. The capitalization rate ignores the effect of debt financing. Cash-on-cash return focuses specifically on the investor's deployed capital. It is the final metric for judging investment success.